Dodd Frank created a new council made up of bigwigs from the Treasury Secretary, the Fed, the SEC and more. Its goal is to keep banks, hedge funds and companies from becoming too big to fail. It does that by making firms keep more money on hand, and they even have the power to break up companies that are a grave threat to financial stability.
Agencies such as Moody's and Standard & Poor's evaluate how risky an individual, company or even a government is to lend to. So, in theory, a bad rating warns investors that these debtors may not pay back their loan. But during the financial crisis, we learned a lot of risky debt was being given good ratings. Now these agencies are monitored, and unreliable ratings could mean they lose their standing.
So the Fed's emergency loans during the financial crisis raised a lot of eyebrows, which is why Dodd-Frank gave the government new power to audit these loans. Now the government has authority to audit the Fed again in the future, and all emergency loans must be approved by the Treasury.
Okay, there are many types of derivatives, ones that help keep the economy stable and ones that did the complete opposite. One of the more controversial of these is the credit default swap. Here's how it works. Say you're giving a company a big loan. It's a great deal if you get all that money back. But what happens if the company goes bankrupt? Well, that's where the credit default swap comes in. It's your insurance. But before Dodd-Frank, swaps weren't regulated, and the sellers of credit default swaps didn't actually have enough money to pay out if the worst happened. Now, thanks to Dodd-Frank, these insurance-type products are more heavily supervised.
So when you deposit your money into a bank, you expect for it to be kept safe and sound. But before Dodd-Frank, banks could use your money to trade for their own personal gain. Now they have to get out of that business unless you specifically ask them to trade on your behalf.
The Senate passed bipartisan legislation Wednesday designed to ease bank rules that were enacted to prevent a relapse of the 2008 financial crisis that caused millions of Americans to lose their jobs and homes. A bill from Republican Senator Mike Crapo of Idaho that would dial back portions of the law known as Dodd Frank. How did your senator vote? To give the banks another break. Despite strong support in Congress and in the banking industry for reforming DFA, congressional enactment of DFA reforms and related regulatory reforms may not happen this year despite the Senate action and earlier House passage of DFA reforms spelled out in the Choice Act. Call or email or write your representative today. Let them know how you feel.